Hello everyone and welcome to the webinar today titled Answers to Your Top 5 Questions and Concerns About Investing for Retirement or to Create Wealth, hosted by Shawn O'Hare, CPA and PFS of O'Hare Financial. For over 20 years, Shawn has helped Southern Maine area businesses and individuals solve financial challenges, alleviate tax issues, and meet their financial goals. As the owner of O'Hare Financial, Shawn is dedicated to helping individuals, families, and small businesses with all of their tax and financial needs. A quick disclaimer before we get started on the webinar. Everybody's personal situation is unique, and therefore the advice and the answers on this webinar are informational only and should not be implemented or acted on without first consulting your investment advisor and or tax advisor. So without any other delay, let's go ahead and get started. Shawn, welcome to the call.
Great, Jeff. Thank you so much. As many of you who are on the call know, because many of you have been my clients for several years, I recently have branched out my offerings to financial services. And the reason I'm decided to get into the financial services is because so many of my clients are coming to me with financial questions, as they get close to retirement, or whether they're trying to fund college education for their kids or just trying to make ends meet. So offering financial services, like I said, is just kind of a natural extension of my CPA practice. And really, so many times, a financial decision has an impact on your taxes, and tax decisions have impacts on your financial situation. So what better way than to have one person that you can come to for tax and financial issues. So with that being said, let's just jump in here. We sent out a questionnaire several weeks ago to my client base, asking them for what their concerns are when it comes to finances. And what this webinar is today is really a culmination of the 5 top questions that we received from the clients. Obviously, we're not touching on everything. So if there are things that are not being addressed today or you want to come in and meet with me about, please don't hesitate. So again, top question number 1. As you can see, is how much money do I need to have to retire and then live comfortably? And I got to be honest, this question I get so many times a week during tax season, just during the course of the year. And I think a lot of people are concerned about how much money they're going to need to retire. I know that a lot of people back, especially with 2008, the portfolios may not be where they were at one point, and people are still trying to rebuild what they've lost. But when it comes to retiring and how much money do I need to retire comfortably, because nobody wants to be destitute when they retire, I think the first thing I want to do is look at how much we're spending today. How much do I need to live today? You might have a mortgage now, but you may not have a mortgage when you retire. So those are things you want to take a look at. Your medical expenses may increase as you get older as opposed to now. But I think the first step is to say, how much am I spending today to live? And come up with that number. And then, what do I need to live when I retire? Is it going to be higher? Is it going to be lower? It's going to be the same. Like I said, you may not have a mortgage when you retire. Your medical expenses might be higher. Your kids might be through college at that point, so you don't have tuition bills anymore. Your cars might be paid off. Those are things you want to be looking at. And then figure out, basically you're doing a budget now for the future. The key is really to have kind of the quote-unquote nest egg for when day one of your retirement comes. And so we're not touching the principal. And obviously, as Albert Einstein said, one of the greatest inventions is compounded interest. Well, when you have your nest egg, that is still compounding every year while you retire. But you want to make sure that the interest and the dividends that you're getting from your nest egg is going to be enough to support your lifestyle. Simple example, you're earning 10% in your portfolio, you need $100,000 a year to live on, obviously you'll need $1 million to invest. Now, getting 10% in this market is still a little tough, and especially if when you go to retire, getting 10%, that's going to put you into some pretty risky investments, I would think. So getting 10% on your portfolio at the age of 72 may not be ideal, may not be realistic. You could earn 5% on your portfolio. And then obviously with $1 million, that would give you $50,000 a year to live on. And that $50,000, again, is going to be interest and dividends, going to be potentially subject to income tax. So we need to take that in consideration. But the key is we don't really want to be touching the $1 million or whatever the nest egg is, whether it's $1 million, $500,000, whatever that amount is. We don't want to really be touching that, especially in the first several years of retirement. It's okay to touch principal, though, if we think we're going to, have a life expectancy of 25 years after retirement. Towards the end of that period, we can touch the principal. If you're looking to, set up a college funding for your grandkids, for example, there's ways that we can do that as well by setting up maybe a trust for them. So we're not touching that principal as part of the retirement. But again, towards the end of the retirement, we need to touch principal. We can, because like the old adage says, you can't take it with you. So, but again, first step, how much money do I need to retire and then live comfortably? Do a budget. Moving on to question number 2. How do I invest to maximize returns and minimize risk while protecting my initial invested principal amount? Great question. Obviously, everybody wants to minimize the risk and maximize the returns. So a high return on the investment and low risk, they're usually, as it says, mutually exclusive. If you want low risk, then we have to have low volatility. If you want higher risks, if you want a higher return, you got to take a higher risk. It's kind of the way it works. Finding that happy medium is really what we're trying to accomplish. How much risk do we want to take on? And is that risk equivalent, going to be acceptable for the returns that we want to take on? And the way you do that obviously is through diversification. Diversification minimizes the risks. And with diversification, what we're talking about is there's call it a formula, so that when you're younger, you may want to have more risky investments because we have a longer time horizon to make up those returns. As we get closer to retirement age, obviously our risk will probably or should decrease. So then we would have maybe potentially more bonds as opposed to more stocks. When we're getting close to retirement, we may not want to have some international high-risk investment in our portfolio. But there's also diversification, again, between bonds and stocks and money markets. There's different sectors that we could be looking at. Having just one class of stock, though, say in pharmaceutical, is not diversification. Even if we have multiple stock companies or pharmaceutical companies in that portfolio, that's not diversification, because something happens to the pharmaceutical market, everything goes down. We'd want to have maybe something to balance the pharmaceutical market. We could have diversification among mutual fund families or asset classes, or even geography. We may want to have some stocks, some companies in Asia and North America. That would be a geographical diversification. And as I mentioned, really the younger you are, the more aggressive you can be. So again, if you are a 20-something and you're investing in a 401k, through your employer, you may want to be investing in international stocks because, again, if there is a downturn in that market, you have a longer time horizon to make that money, those returns back up. And then I give an example here, the asset class diversification. We have a $500,000 in a residential real estate and another $500,000 to invest in stocks. We could be more aggressive in the stock market because the principal amount in the real estate is really going to be relatively stable. You know, there is always the chance of quote-unquote proverbial bubble that we had several years ago where the stock or the real estate market was going up, and up, and then it just crashed right down. But we're now in the upturn on that. You know, especially here in Southern Maine, property values are recuperating and doing pretty well. So, but again, to maximize risks, maximize the returns, and minimize the risk, we've got to find that fine line to walk on. You know, can we take less risk and have better returns? So those are things that we want to be paying attention to. The third question, I love this question. Should I invest using a Roboadvisor, a passive strategy, or continue to actively invest on my own? That's really, I think, a personal choice. If you have plenty of time to be studying the stock market, to be reading the Wall Street Journal on a daily basis, to be looking at Morningstar, then, yeah, you could probably use a Roboadvisor. You know, but if you're looking to just kind of throw money, kind of what I call the spaghetti method, throw it into the market and see what sticks, well, look at what I'm pointing out here for the 2018 average return on investments. You know, and this is usually a strategy you use in passive investing. You're going to invest with the S&P 500. You're going to follow the NASDAQ. 2018 average returns were down in all of those indexes. S&P 500 was down 6.2% in 2018. NASDAQ down 3.9%. So for 2018, using kind of that passive investment strategy wouldn't have turned out so well. But like I said, though, if you have the time to do your own research and trading, and you think you're good at picking the stocks and you enjoy it, say you have a Scottrade or an E-Trade account, then do it. But really, you know, other factors come into play there. If you're going to be investing in the E-Trade or Scottrade accounts, you still want to make sure you're diversifying like we just talked about. But again, if you don't have the time or you don't feel comfortable doing it, you know, then have an investment advisor to help you. And if you realize or not, but having an investment advisor, you're not paying for that out of pocket per se. Where an investment advisor gets paid based on the assets under management of that. But the assets under management with an investment advisor are being looked at on a regular basis. And then if we have to, we can diversify. We could get into different sectors based on what an investment advisor sees what's going on in the market. So actually, that's a great segue into this. So if you have a portfolio, if you've been doing a Roboadvisor or, you know, using a different advisor and you want a second opinion, that is something we can certainly do. You know, but again, a smart investment plan for the second opinion depends on knowing your personal financial situation and your financial goals. So that's really where I come into play, because I've been working with many people, you know, as far as their taxes are concerned for so many years. I can see where you are today and what your allocation is. We can discuss what your financial goals are. You know, is that paying for college? Is it retiring? Is it, you know, retiring and taking a year-long cruise. And then we also look at the risk tolerance, because again, you don't want to be too risky. Yes, you might earn 10%, but you might be in a situation where the risk is just too much, and you could lose that 10% the next day. So we can talk about your risk tolerance, and then what I would do is present my analysis to you with what I see as my observations, whether or not you are meeting your goals, you're not meeting your goals, what we need to do to get you back on track, and any suggestions if you're interested to, reach your goals faster. I mean, wouldn't it be great if we could all take early retirement? But the other thing too, and this is where my experience as your CPA comes in, is to reduce or delay any tax impacts. Because again, financial decisions impact taxes. Taxes can impact finances. So moving on to question number 4. My concern is not having enough time or money to invest given the level of risk I'm willing to take. That's a concern of, I think, everybody, not having enough time or money to invest. Not enough money. Make whatever you do before you start investing after-tax dollars. I highly suggest and recommend that you're maxing out your employer's 401k option, if there is one. Maybe they have a simple IRA. Make sure you're taking advantage of those vehicles first. That money's coming out pre-tax, so it's not impacting how much money you have to spend net, because you're not even seeing that money. It's gone before it goes into your pocket. Reduce your discretionary spending to save more. Just even a simple budget. Dave Ramsey, who is a nationally known radio host on financial topics, talks about his baby steps. There's, I believe, 7 baby steps. He also talks about, he has what's called the envelope method, which is where you put money into, you assign a topic to different envelopes, and you put the money into those envelopes as you go along. But there's so many options out there. Credit Karma has a budgeting software. There's just so many apps that you can find for a budget to help you navigate that. And it's funny, we call it the latte syndrome. You don't realize how much money you're actually spending at Starbucks on a daily basis for that grande latte, until you start actually writing it down. It's just like when you're trying to lose weight, if you're using an app and you're recording all your calorie intakes from your breakfast, lunch, and dinners, and you realize, wow, that Big Mac was probably more than what I should have had for lunch. Well, the same thing goes with the money too. If you're writing it down to see on paper how much money, where your money is going to, it's a great thing. Yeah, another option if you don't have enough money, get the second job. Nights or weekends, drive for Uber or Lyft. Now, in Maine, that may not make as much money as, say, New York City, but, it's still an option. Be a secret shopper. Just anything to get you back on track and get your budget so it's not negative. And then not enough time. There's never enough time. But make sure, again, you're using your company investment options, the 401k match levels. Even if you can't contribute the full amount to your 401k, make sure you're at least putting in what your employer will match up to. Many employers match up to, say, 5% of your pay. Well, take advantage of that, because that's basically free money to you. As I mentioned to clients, when we're in a meeting, if there's $100 sitting on the sidewalk and we can see it through the conference room window, we're going to be pushing each other out the door to try to get there first. Well, you're leaving money on the table if you're not maximizing the amount of your employer match. And then also, use an investment advisor. As I mentioned, there's no cost to you to use an investment advisor, and they can help you manage and invest your portfolio. and we've talked about this so many times just on this topic. Reevaluate your risk tolerance and your financial goals to see where adjustments can be made. You can't, it's not a set and forget type of thing. You have to be looking at this on a regular basis because things change. Maybe the money you've been saving for your kids' education, for college education, and they get a full scholarship. Wouldn't that be great? So you always need to be looking at where you are if you want to get to the end of the road. And then finally, question number 5. How safe are my investments from stock market fluctuations in an unstable market and world? Fluctuations, they happen all the time. Some days the market is up, next day it's going to be down. That's just part of volatility. You can't be looking, the trick is not to look at it every day, because there are going to be the ups and the downs. That's just part of volatility and part of life. And then how safe are my investments from stock market fluctuations? Safe is that term needs to be defined. What could be safe for a 20-something may not be safe for somebody in their 50s, and vice versa. You need to be looking at the long term, and that's really the key. The long-term investment horizon, and ignore the daily and the weekly fluctuations. Because, back in 2008 when we had the big crash, people were looking at that thinking, I just lost all my money. Well, it was really an unrealized loss. The market comes back up and your gains come back. And whatever you do, don't try to time the market downturns, because as consumers, we're kind of a step behind as far as the run-ups and catching the downturns. If you hear about a product, Apple is coming out with, say, the best phone ever, well, by the time we hear about it, it's already been absorbed in the market. So the price of Apple has already been adjusted for that. So by the time we learn about it, we're a half day late. The trick is to use dollar cost averaging, which means you're always putting in money into the market, whether that's monthly, quarterly, and you just put it in there. Some days, if you do dollar cost averaging, you're putting in $100 into a particular mutual fund. Some days it might buy 2 shares. Some days it might buy 3 shares. But the thing is, just keep putting it in, because over time the market will run up. And then I've listed here some safe investments. You could just put the money into a bank account, and it's earning 0.09%. Money markets, I have some listed here. 0.18% for under $100,000, 0.29% over $100,000. I want my money to work much, much harder than that. So, yeah, that's going to be a safe investment, but it's not going to get you to the end of the race with those types of returns. And with that, I turn it back to you, Jeff.
Okay, Shawn, thanks. And if you have a question, I've been trying to watch, Shawn, on the chat. We don't have any questions right now, but the phone lines are open. And if you do have a question, just go ahead and chime right in, and we'll give it a couple seconds to see. Usually everybody's pretty shy on stuff like this, and so we may not have any questions today. But, yep, nothing so far, Shawn. I think we're good.
Okay.
You've answered, those five questions cover a lot of ground. I think you probably answered a lot of what was on people's minds.
Those questions, again, doesn't cover everything, but obviously that's what seemed to be on people's mind when we sent out the survey. And, if people do have more detailed questions, be more than happy to sit down with people and discuss them and move forward so we can reach the goals.
Great. Hey, Shawn, if somebody is listening on the replay, which we're going to be sending out, what's the best way for them to get a hold of you? I know you got a lot of different options, and I see you can even schedule appointments online on your website.
Yes, they can definitely go to the website, o'harefinancial.com, and schedule an appointment there, or they can call the office at 200-1500 and schedule an appointment that way. Love to sit down and help people reach their financial goals.
Super. Well, Shawn, hey, thanks for taking time out of your day. I know you're busy to talk about these answers to the top 5 questions and concerns about investing for retirement or to create wealth. And again, everybody, if you're listening on the replay, feel free to contact Shawn. There's the website on the page, and you can email him at Shawn@o'harefinancial.com, and the phone number's right there too. So, Shawn, again, thanks, and we'll hope to talk to everybody soon.
Great. Jeff, thank you so much. Have a great day.
You too. Thanks, everybody. Bye-bye now.
Bye.